Hi, everyone, and thank you for joining today's webcast. My name is Filip Vukovic, and I'm the head of transfer pricing with KPMG Lower Gulf and the regional practice, and I will be hosting today's session along with my colleagues who I will introduce shortly. Before we begin, we hope that you and your family, along with friends, colleagues, and business partners, are keeping safe and well in these troubling times. COVID-19 situation continues to evolve, but to start in a more positive note, a number of countries around the world have gradually started lifting restrictions and are envisaging the resumption of business activities and reopening of respective economies. We also have some great news from New Zealand, where the community transmission has been stopped, which is a success demonstrating the effectiveness of restriction measures that have been imposed worldwide. The purpose of today's webcast is to continue sharing our global knowledge and experiences from a tax perspective. And this session will be focused on M&A and debt restructuring tax aspects and attributes. Things are moving so quickly worldwide, so we will try to provide you a broader perspective on what is relevant for the GCC region over the next half hour. As always, please do get in touch with your local KPMG contact and assess the situation you are facing to find the most optimal solution for your specific needs. Next slide, please. I will note that this is the fourth of the series of recorded 45 minutes weekly webcasts by KPMG around the Middle East, so stay connected for future releases. There will be more to come. Your feedback on the end of today's session is highly welcome, and your participation will help us improve in the future. If you have missed previous sessions, recordings are available online. If you have any technical questions, please use the question mark button and a member of our team will reach out to you. You can also use the chat box in the player. We have left some time for questions from the audience at the end of today's sessions, and you may raise questions as we go along with the presentation using the Q&A box, as we want to make the discussion as interactive as possible. Next slide, please. I'm joining you today from Dubai, United Arab Emirates, and I'm accompanied by my colleagues from the GCC region. Let me introduce you to today's presenters. We have with us Eric Janovac, which is a US Accountant Managing Director, David Fernley, an ITS Director from the Lower Gulf Practice, and Peter Burke, who is a Senior Director and the Head of M&A and ITS with the Practice of Saudi Arabia. And these gentlemen have significant tax experience in M&A, deal making, and investments, all activities which were significantly impacted by the COVID-19 outbreak. Namely, apart from some recent notable exception from the Kingdom of Saudi Arabia, deal making is currently on a historical low, comparable only to the peak of the financial crisis in April 2009. The multi-year boom in mergers and acquisitions activity abruptly came to a halt by the end of March, as the fallout from the coronavirus pandemic ravaged corporate share prices and redirected the focus of executives towards saving their own companies instead of trying to buy others. And when the COVID-19 outbreak is under control, investors, funds, private equity houses, and corporates will return to a new normal, which is what we wanted to discuss with you, and therefore have prepared the following agenda for today's session. Next slide, please. We're going to start with a comparative analysis of the GCC investment environment and tax dynamics by taking 2007 and 2020. Then we're going to see what is important for the M&A tax practices going forward after the COVID-19 outbreak, followed by a discussion about restructuring of debt and other consideration in respect to financial transactions. With that said, I'm going to hand over to Eric to give us an overview of the GCC investment environment. Eric.
Thanks very much, Philip. And thanks everybody for joining today. I think it's helpful to start with a look back to 2007. And the reason for that is because it was the entry point to the last major economic slowdown. And the second reason why it's relevant for the GCC region is that it is essentially a point of a distinct change in the M&A environment within the region, largely driven by the sovereign wealth fund activity. If you look at M&A across the region, it really has been driven by government investment over the past 20, 30, 40 years. And over the course of 2007, an interesting dynamic started to take place. You saw that global sovereign wealth funds had collectively started to invest almost $45 billion into financial institutions, which was largely driven by a need for an increased regulatory capital in advance of the looming global financial crisis. And so when you look at the sovereign wealth fund investors from that time period, they were just starting to be active at the global level in particular, and they were getting in large ticket transactions and also in the alternative asset space. And that's important to note because for most of the history of the sovereign wealth funds up until the early 2000s, from a portfolio allocation perspective, they were largely investing in safe haven type assets focused on treasuries and index replication, mostly passive liquid mandates. And so if you look at then the regional dynamics at the time from an economic perspective, there's one really important takeaway, and that's that we were in a period of high oil prices. And that was leading to an increased amount of foreign reserves and also then allocations to the sovereign wealth funds. And so after 2007 and up until 2020, we went into the global financial crisis, but you saw that the sovereign wealth funds were continuing to grow from strength to strength and were quite active in the global M&A space. And so then if we fast forward and pivot to 2020 and where we are right now, we're in a much, much different environment than we were in 2007. To start with, we are in the midst of the COVID health crisis, which is really an economic crisis. It's crippled the economy and it's crippled society. The global financial crisis, in contrast, was largely economic focused. And so when you kind of look at, a little bit before COVID, try to identify where we were from an M&A perspective in the region, again, I think it's important to start with oil. We were in a period of lower oil prices on average than what we were in 2007. And the prices were consistently below most of the regional government break-even points from a government budget perspective. Government budgets were relatively high. And when you look at the regional M&A activity outside of the government and sovereign space, it was largely focused on the energy and banking sectors. A couple of examples come to mind. In 2019, you had the sale of SABIC by PIF to Saudi Aramco for $70 billion. Here in the UAE, you had a really significant sale from ADNOC of 40% of its pipeline business to KKR and BlackRock for $4 billion. And when you look at non-regional money coming in from third parties, you had the sale of Careem to Uber in March of 2019 for $3 billion. And in addition to that, on the banking side, you had an incredible amount of consolidation that's been happening over the past 10 years of all of the regional banks are largely starting to become much larger regional banks by acquiring the smaller regional banks. And so another important touch point here is just to note that across the region, historically, 2/3 of the M&A buyers have been local. And so when you look at M&A in the region, it's still very much a local play, but the outside investment coming into the region is becoming increasingly more considerable. And then in addition, the sovereign wealth funds not only have been investing in the region locally, but they continue to deploy cash overseas. Peter, I think you had a couple of
Eric,
comments you wanted to add.
I might just jump in and just to add an observation. If we can just go back to if we can stay on that slide. One thing that's a big difference, I think, between 2007 and 2020 is the increasing use of public-private partnerships. So they were quite common in the Europe, US, and Australia, and increasingly we're seeing them within the region. In particular, in Saudi, just to note, they're being used for road development, power, and infrastructure such as hospitals and things. So they tend to be very large, chunky amounts of investment, generally with quite long lives, generally running out to 25 or 30 years. So a question will remain to be seen whether we'll see any IPO activity coming out of the triple P space, because what's happened in some other parts of the world is that you get the first entrants who come in, and then they do a sell down into the IPO market. So that'll be one to watch from an investment space.
Thanks a lot, Peter. And I think that this gives a kind of good overview of the GCC investment environment. Eric, could you perhaps drive us to, in parallel, what were the tax dynamics that we were seeing in 2007 versus 2020?
Yeah, absolutely. I mean, it's really important to note that from 2007 to 2020, the tax landscape has really shifted dramatically. And that has some really important implications for the M&A space, because there's three large themes that have seemed to have merged over the past 13, 14 years. And those are largely focused on transparency and post-BEPS tax structuring type strategies. And then this idea of, is there a fair tax or a global minimum tax or a certain amount of tax that you should always be paying, regardless of what type of investor you are or what type of transaction you're engaged in. And so I'll start off with transparency. When you look at 2007 and the time prior to that, the landscape was not focused on transparency. Yet post-2007, and perhaps as a result of the global financial crisis, you saw a number of initiatives starting that were focused on bringing transparency into the tax landscape. And the first one that I would point out is that the OECD BEPS initiative, the goal was really focused on implementing standards related to tax transparency in order to allow tax authorities to be better able to identify and deter tax evasion and tax avoidance. And so when you look at BEPS and you kind of try to identify what was happening at the time, there was this huge focus on trying to identify whether companies were evading tax or avoiding tax, or individuals were avoiding tax. And the US had implemented post-GFC FATCA. And the FATCA regime is probably well known to many people on the phone. Even if you're not a US citizen, it affects you in the banking environment. The goal of FATCA was to identify US assets and bank accounts owned by Americans and located outside of the United States. But in order to do that, FATCA required a pretty incredible multilateral country cooperation. And it basically put its standards on other countries to enforce its laws outside the United States and identify US citizens versus non-US citizens, which in the process of that was really identifying who the account holders were of all accounts, whether you were US or non-US. As it turns out, FATCA was quite revolutionary, and it gave the OECD a little bit of wind in the sails to start developing its initiatives. And some of these initiatives, the results were things like CBCR, which would be country-specific reporting that relates to what financial information and activity are related to or performed in which country. And then you have CRS, Common Reporting Standards, which is basically a standardization of what information is shared between countries and which should be automatically exchanged on reportable persons or accounts or transactions. And then you have other regimes like DAC 6, which is an EU directive, which is focused on mandatory disclosures of specific transactions that have hallmarks of tax avoidance and tax secrecy, and that previously would have been confidential transactions and now have to be disclosed to the country tax authorities. And then when you parlay that into other non-tax focused initiatives on the risk and governance side, just with respect to, for example, sovereign wealth funds, in 2008, the IMF was pushing this idea that maybe there should be some common standards applied to sovereign wealth funds in light of these really large cross-border transactions that we're making. And these standards were designed to address essentially transparency, independence, and governance among sovereign wealth funds. So they were all trying to essentially behave in a more lockstep manner and bring standardization to how they were going to market. And in addition to that, you found that within the media, you were seeing a much more increased public focus on tax, particularly a media interest in tax evasion and tax secrecy, and generally whether companies were paying low rates of effective taxation. And then when you look at the regulatory environment, this was not necessarily new at the time, but it's always been existing in the background. Just in the United States and other countries have similar regimes, CFIUS adds additional complexity when you consider it along with these tax transparency initiatives, because CFIUS is essentially a government review of large cross-border transactions, foreign direct investment in the United States, typically characterized by investments in US infrastructure, whether that be IT or telecom or agricultural or ports. But basically it allows the US government and administrative executive body broad remit to go in and review cross-border transactions. And so what's the takeaway here? Well, the takeaway is that all these disclosures have the potential to create friction. There's a focus on transparency and this public interest in cross-border M&A. It can create undue attention and it can potentially move markets. And while nobody in this space necessarily wants to be hiding in the shadows, but with these increased transparency standards, it does kind of make you worry a little bit that it could create friction in the M&A environment.
Thanks a lot. David, would you perhaps like to comment on the tax structurings that are going to be in this post-BEPS environment?
No problem. Thanks, Philip and Eric. If I look at deal and investment structuring in 2007, the thought process was pretty much, which country do we want to invest in? What withholding taxes could we leak on repatriation of cash and on exit? And which country has the best tax treaty with that country to minimize those taxes? And let's set up an SPV there and get those withholding tax benefits. Fast forward to 2020, that SPV will have to now meet a bunch of tests to get those tax treaty or other benefits. Some of those were introduced under BEPS, and some of them were ones that existed already but weren't really that well enforced or tested. So if I'm setting up an SPV now or doing an investment in a foreign country, I want to know that the company making that investment, is it tax resident per the tax treaty? There could be tests around being liable to tax, subject to tax. Does it meet a principal purpose test? So is one of the principal purposes of the transaction to get those tax benefits? In some countries, there'll be a limitation of benefits test, particularly Eric's home country, the US, will want to know who the ultimate owners of the company are. There can be general anti-avoidance rules and beneficial ownership tests. And all of those are now much more robustly enforced by foreign tax authorities. So I think the picture for tax structuring now is there is less tax structuring. There's a flight to simplicity. And we're seeing private equity groups and sovereign wealth funds say, can we just invest directly here? Even if there is tax leakage, perhaps we just have to live with that and not have reputational and risk around not getting the rates we expected. Or do we place our bets in one place that we like as a holding company jurisdiction for a certain region? Do we do everything in Europe through Luxembourg? Do we do everything in Asia through Singapore and build up substance and presence and commercial purpose there? My punchline to that as well, the terminology substance is used a lot in tax at the moment. And I think generally all those tests I just mentioned to some extent are met by substance. But there are things there that are just factual and not all about the substance. I could have 10,000 employees in a company and still be denied treaty benefits if I'm not the beneficial owner, if I'm passing all the returns on. So substance is important now. but there's more to it than that, and these tests vary by country, by treaty, by tax. It's a very complicated landscape we're in now. So that's where I'd say we are now in terms of tax structuring. Peter, I know when we were talking about this yesterday, you had some interesting views on the public perception of tax and sort of paying the fair share. Do you want to talk everyone through that?
Yeah, sure. Look, I think it's relevant sort of to go back to pre 2007, and I look at when I started working in international tax and structuring. The emphasis was very much on creating structures that would result in the lowest effective tax rate possible. And that I've got to say that saw some very complex structuring on both the equity and the debt side. And if we're doing very large transactions and we were looking at significant amounts of debt, it was very common to enter into hybrid financing arrangements that would generate a multiple deduction, maybe 1.5 to 2.5 times the actual economic cost of interest. And so that it was very much the key drive was pushing down tax as low as possible. In a post GFC world, where there's been increasingly all countries focused on making sure that they were collecting their appropriate share of revenues, and we saw some very public cases. But probably one of the most notable was the UK inquiry, where some of the major multinational corporations emanating from the US were interrogated by the UK, you had Google, Amazon, Starbucks, Apple, and amongst others. And there was one case that stood out very clearly, where one of them had never returned a profit in the UK, but every year had been opening new stores. And they highlighted on that as an example that there was a clear mismatch between the economic performance and what was being returned as taxable profit. So there was a lot of reputational damage done to that. There was not just in the UK, but in many jurisdictions, there was a lot of restructuring that was done to basically put tax back into jurisdictions. There were catch-up payments made on tax to settle, with revenue authorities. And globally, I think it was very much. It wasn't particular to one jurisdiction. It's been a global issue, and that's led to, at the corporate level, an increasing emphasis on tax governance and risk. And in particular, that's to protect, as Dave was saying, against two things. One being the actual risk of being hit with penalties and primary tax. The second one is, which is increasing the emphasis, is the reputational risk, which is a paramount issue now. So we can probably move on to the next slide now, I think.
Thanks a lot, Peter. Yes, I wanted to ask you, gentlemen, that was 2007 and 2020, and what is now important for the M&A scope from a tax perspective post-COVID?
Yeah, that's fine, Philip. I'll pick this one up. We've identified 3 areas going forward. That was a lot about the past. I think that the future's a lot more of the same, but we've considered tax law changes, commercial impacts, and operational impacts in this environment. In terms of tax law changes, I'm sure all of your inboxes and social media feeds look very like mine. You're seeing lots of tax and legal COVID updates. They're coming fast. I think that will continue. And the updates, they're a mix of tax incentives, government incentives that are administered via the tax system, like the UK employee furlough scheme, grants and just some stimulus from bank lending and guarantees and so on. These changes are coming thick and fast. They're happening on the day and they're complicated. US CARES Act, I think Eric can correct me if I'm wrong, 800 pages long. All these changes could have a huge impact on a model for an investment or a live deal, and it will put tension on existing deals around where are those benefits accrued, which party should they go to under the contractual arrangements. I think the most interesting angle around all of these, though, is just to go back to what Peter was saying about reputational concerns. There's been a lot of conversation in the financial press recently about whether private equity investee companies should benefit from these incentives, and some bad press for Shake Shack, Richard Branson, Victoria Beckham, and lots of English football clubs. I won't name names on the football clubs because I know people can get very passionate about these things. But I think on any deal or investment, looking at this as a diligence point around, are we inheriting a bunch of reputational risk here, is going to be very important. The final thing I'll say on changes is I think it's not all things that are in favour of the taxpayer. It's not all delays to tax filing deadlines. OECD has quite strongly said they want to push on with the really important things, such as BEPS 2.0. How do they tax digital companies? Is there a way of creating digital nexus and also introducing a global minimum tax? The plan is that will be settled on in 2020. There's still some press saying, can they really do that? Is it pro-taxpayer in this environment? But OECD seem to very strongly feel they want to push on. The other thing I expect, and I'm not going to try and be an economist here and say, do all governments need to raise more revenues, or with deflationary effects going on, can they keep printing money? But I think it's inevitable some are going to have to. And often the first place they look at is how can you increase cross-border taxes, so withholding taxes, non-resident capital gains taxes and transaction taxes, because they don't target the domestic market and the voters ultimately. And I saw that post the financial crisis, you saw countries with varying degrees of effect trying to introduce non-resident capital gains taxes. Mexico, Argentina, Greece all tried. Many countries increased their withholding tax rates, particularly to what they deemed to be tax havens. And of course, the EU FTT was put on the table. I expect to see more of that, perhaps some increased support and impetus behind the EU FTT, which still acts as a proposal. And the first sign we've seen of that is some announcements from Mr. Putin in Russia around trying to very quickly and almost unilaterally increase the withholding tax rates for investments coming in from countries like Luxembourg, Cyprus, the Netherlands, trying to have a minimum treaty rate of 15% withholding tax. So I think we will see more of that. That'll put tension on tax structuring, as I've just discussed. Peter, the corporate tax rates get similar to what I've just been talking about, but you have a view on this you wanted to discuss?
Sorry, I forgot to unmute. There's been a general movement to reduction in corporate rates of tax, and we saw that Ireland had basically a tax haven zone, and then to avoid the issues associated with tax havens, they reduced the whole rate of tax for the nation as a whole. We've then seen the UK drop its rate down, and very recently we saw the US take a very dramatic drop in their corporate tax rate. And there's other nations that are looking at dropping their rates of corporate tax, because there's a view that when you're competing for investment, that you need to be competitive on corporate tax rates, and they generally tend to be falling between 20-25%. and if you're above that, then it's viewed as uncompetitive on a corporate. But the point to note is that in light of the COVID-19, it's, you know, many countries will be focusing on their revenue collections and question whether that's going to defer or permanently affect reductions in corporate rates of tax.
Yeah, it's a really interesting dynamic that we're facing, because on one hand, you have governments around the world that are seeing decreasing tax revenue as a result of decreasing economic activity. And so there's likely to be a need to raise tax revenue to fill the government coffers. And at the same time, they're going to want to invest or attract foreign direct investment. And the way typically to do that is to make things more tax beneficial, which would be, you know, along the same lines, continuing to drop corporate rates or provide for tax holidays, which again, at the same time, isn't a tax revenue raising scenario. It's quite the opposite. So there's going to be a huge balancing act going forward. I guess the big kind of takeaways for tax dynamics on the commercial side are that really the post-tax rate is going to be quite important. You're going to want to look at whether there are tax losses and attributes that you can take advantage of. You're going to want to know whether the debt restructuring that you're stepping into or that you're part of has any tax impacts. And from an opportunities perspective, there's likely to be a huge set of restructurings and distressed credit opportunities coming up in the market. And maybe we should move to the next slide and talk a little bit about the debt restructuring space.
Yes, because I think that there's going to be a lot of our people on the call here, which companies might have kind of difficulties in repaying their credit facilities and might need to restructure. So Eric, could you perhaps guide us on what are the important aspects to cover from that perspective?
Yeah, sure. And just a couple of data points to start off with. And I'd say, well, why is this important? And there's a couple of things that I think it's important to keep in mind. Currently, there's nearly $1.5 trillion in investment grade, non-investment grade junk bonds in the global market, maturing by 2024. This is the most speculative credit class, and Goldman Sachs is estimating that 13% of this class will default over the course of 2020, and hopefully that rate will decline over 2021. That's an incredible amount of default, and that's not even taking into consideration the investment grade space, which will likely have at least some defaults in it. And so when you look at the US alone, there's $6.7 trillion of outstanding investment grade corporate debt. And globally, just at the global level, there's over $100 trillion of investment grade and junk bond debt in the public and private markets. And so that's an incredible amount of debt that is going to be very likely focused on restructuring over the next 12 to 18 to 24 months. And so if we look at then, why is that relevant from a tax perspective? And well, actually, we'll just focus very quickly. What could happen in a debt restructuring? There's a couple of different scenarios that you might see. You can see white knight structuring, where a lender comes in and looks at all of the other creditors and the existing capital structure and advances funds to help that company avoid bankruptcy and becomes the senior lender. You can have an out-of-court situation where all the lenders negotiate to restructure the debt outside of the bankruptcy court process and agree to stay out of bankruptcy court. Or you could have the lenders negotiating amongst each other and coming up with a plan of restructuring in advance of bankruptcy that the court then adopts. Or you can go into bankruptcy if nobody agrees and let the court administer the restructuring process through the negotiation of the lenders. And usually bankruptcy is probably the least desirable, but it kind of depends on the facts and circumstances. And so when you then look at the tax effects of this, it's largely, if we want to go to the next slide, It's largely relevant to the cross-border space because there's no corporate income tax here, and so the tax effects here in the region for debt between local country lenders and borrowers, there's not many tax implications of it. Claire, the next slide, please. But there's some big themes you should be aware of in the cross-border space from a tax perspective when it comes to restructured debt. The biggest themes are you can end up in situations where you have cash tax obligations, but there's no cash distribution as a result of the restructuring. And where might that arise? That might arise when a borrower had a debt outstanding that might have been worth 100, but through negotiation with the lender, they agreed to reduce the principal amount down to something less than 100. And whatever they reduce down less of 100, in many jurisdictions will be treated as cancellation of indebtedness income. Another thing that can happen is that as a result of the restructuring, you may have a change in character of the investment tax treatment for the lender. And that happens where you can have a significant restructuring of debt. You can have a debt for equity for debt swap where the borrower provides equity in exchange for the debt, or new debt in exchange for the old debt, or contributes out assets in exchange for the debt. And those all have taxable, essentially, exchange implications for the lender. And in a situation where they may have not otherwise have thought that they had any tax effect as a result of maybe receiving interest in a cross-border context, tax-free, it can change the dynamic and turn that tax-free interest into either capital gains exposure or an equity interest in something that has a real estate tinge to it that then creates a tax filing obligation and a cash tax obligation. Another important dynamic is, as a result of the restructuring, the borrower company itself may end up avoiding having any cash tax obligation that they have to pay out. But in exchange for that, there may be a limitation on tax attributes that they have, like net operating losses. And that's because as a result of significant restructurings, they're often treated by tax regimes as a change in beneficial ownership, which has oftentimes limitations on utilization of the tax attributes going forward. And so the biggest theme here is that restructurings are not necessarily free. They may be tax-free under certain situations, but they may have tax that you have to pay. But at the end of the day, there's likely to be some cost as a result of the restructuring.
Thanks a lot, Eric. And Peter, may I ask you, like hearing all of these kind of valuable inputs, if we would have to draw a kind of summary of conclusion of what is the important for the M&A going forward, could you guide us to what your findings would be and what your thoughts would be?
Yeah, sure. Thanks. Look, suffice to say, the playbook has changed, and what was previously the focus, and that was, as I mentioned earlier, driving down the effective tax rate to the lowest extent possible, is no longer the approach. I was thinking around really what the critical points are to summarise, and they can really come down to two parts. It's basically identifying what tax obligations are and making sure that they're appropriately met. That's now really a key focus on the M&A side. So a paradigm shift in how tax is approached from an M&A space.
Thanks a lot. And of the changes that you mentioned here, what do you think is going to have the greatest impact to corporates and to businesses going forward?
I think the most fundamental one is paying fair share of tax, and that really draws into question the transfer pricing arrangements as well.
Thanks a lot. Now, I'm conscious on time, and I got a couple of questions from the audience. And one was, I think Terry can answer this one, is what do we see in the short, medium, and long term? What's your perspective on that, Eric?
Yeah, thanks. Gosh, there's so many dynamics at play, but I think if I had to break it out, in the short term, what I'm seeing in the market right now is a lot of players have paused and they are assessing and evaluating as the markets stabilize. And we've all seen the equity markets have had a pretty bumpy ride recently. And with the significant amounts of quantitative easing in the United States, you've seen the markets go back up. But there's a whole host of potential bad economic news that's going to come out in Q2. There have been some notable big cross-border investments coming out of Saudi. You saw some big investments into football clubs and into the U.S. cruise line, and some activity in the oil and gas space. But I think that other players in the market seem to be in kind of the assess stage. In the medium term, I expect to see a lot of strategic deal making. I think that we're probably going to have some great investment opportunities, either in principal investments or by way of LP interests in the big sponsors that are going to out hunting for deals right now, both in private equity and in credit, particularly in credit. I think credit is going to be another growing field, and you saw post 2008 and 9 that credit really took off, definitely from the alternative lending space. And in long term, from the region, I'd say I think it's going to go back to business as usual. I just feel that the region is going to continue to grow from strength to strength on the back of the good policy here, the active government mandate to keep growing the economy in different parts of the economy and continue to pivot away from an oil-based economy. And there's a huge international business appeal to being in the region. And so all of those taken together, I think, are huge advantages and will help push this region along.
Thanks a lot, Eric. David, I had a question about tax administration for cross-border investments, more specifically on what can be done to kind of improve it in this current environment.
So I think the first thing I'd say is the current system around withholding tax reliefs is a complete pain, really. It can slow down deals, it can impact investment returns just because a certain form hasn't been filed. And yeah, the way things stand is most countries have an extremely paper-based system. You have to get a tax residence certificate from the tax authority. A form has to be wet ink signed. It can really slow things down. I've seen a couple of letters that have gone into the OECD from financial services industry bodies saying that in the short term, due to the COVID situation, can there be some allowances around just going electronic, using electronic documents? And I think in the more medium term, this situation gives more strength to the OECD Trace initiative, which was done back in 2013, not widely taken up by countries. And in its most basic form, it's a very simple way of granting treaty relief. It's a simple version of the US QI system. No tax residence certificate, relief at source, minimise reclaims and all the trouble that comes with them. I think this gives that a lot of strength. The benefits to it are it's simpler and it can easily be digitised. Finland's broken away and used the system. I think all tax authorities are looking at administering tax on a digital basis, and in the cross-border investment space, this would be the biggest opportunity, and I think a system that can be digitized and sped up a lot.
Thanks a lot, David. Now, I'm conscious of time, and I think that we have reached the limit. So, gentlemen, I would like to thank you all for this amazing insights that we got and a kind of future perspective on what's happening in the M&A. For the audience, I would like to thank you all for attending. I hope that we have passed some knowledge to you. I would be very grateful if you fill in the form at the end of today's webcast so that we can improve for the next week. Next week, we are going to have a session which will be focused on another round of regional updates. We're going to have Oman, we're going to have Jordan, we're going to have Iraq and Egyptian updates. And we're also going to be discussing and touching base about the energy and resources industries. So thank you very much for attending. We hope that you stay safe, and staying home is now kind of being reduced, but still try to stay home as much as you can. Thank you, everybody.